righty, Bill, kick us off.
Welcome to the new Barbarians podcast, where we mash up markets and economics to deliver actionable insights to our community.
Each week, we break down the macro trends, market events, and investment opportunities shaping the financial landscape, from traditional markets to the emergent opportunity in digital assets.
And everything in between, including my specialty, using AI tools to drive the investment process. Just two Wall Street veterans dropping the Bloomberg for the blockchain.
Whether you're an investor, trader, or just someone trying to navigate the chaos, we've got you covered. The old financial system is shrinking, so we are here to help you understand the expanding opportunities in digital assets.
So hit that subscribe button, follow us on your favorite podcast platform, and let's cut through the noise together. Welcome, everybody, to the new Barbarians podcast. I am Bill Mann with my co-host Mark Connors and our producer Chris Rosa. Today we are joined by a special guest and friend of mine. Please welcome Connor Farley.
Hi, Bill. Hi, Mark and Chris.
Connor, welcome,
Thanks.
my friend.
Thank you. Appreciate it. Really excited to be here.
Connor is CEO and co-founder of Truvius, an SEC-registered investment advisor headquartered in Boston, a firm that helps investors unlock broader exposure and durable, long-term systematic investments for digital assets. Truvius takes a systematic approach to crypto asset portfolio management. The simple mission is to build diversified portfolios of digital assets that target exposures to various investment themes. By harnessing the power of a systematic, theme-driven process, investors can unlock a long-term, more durable approach to harvesting returns from the digital asset class. Prior to founding Truvius in 2022, Connor was an associate at AQR Capital Management. I worked with Connor while he was an intern over 2 summers at AQR over 10 years ago, while he was earning his Bachelor's of Arts in Economics and Political Science at Boston College. I promise I will no longer read from a script, but it was good to make sure I got the initial pitch for Truvius exactly right. And let's kick it off. Mark will give his usual recap of the insane recent events in the markets, and then we will introduce Connor and have a discussion about Truvius and quantitative crypto research.
Great. Thanks, Bill. And yeah, welcome, Connor, to the game here. We usually start out by just doing a top-down view. Where are we today? And I think, looking at the jobs release today, a little bit lower unemployment. You even had some participation rate rise, which means that maybe people are being pulled off their couches in their parents' basement and re-engaging in the workforce. We'll see how far that goes, because that's been the great resignation is really one big problem, where people are sitting on their butts and living off savings or their parents' largesse. Equities down, bonds down, gold up. So I think the biggest theme, and what will play into what you're doing for a living, Connor, and why you're having success, is that we're having some unusual things happen. Gold is up 41% in the last year. It's up almost 10% year to date. Inflation concerns are still there. So why are rates rising and people are still buying gold, which has a storage cost, when they could just, get 4.5% on or 4.25% on a 2-year? That question has not been answered. So there's a cognitive dissonance in the marketplace. I think that it's because there will be continued debasement of the dollar, as the effects of Doge, maybe don't go beyond a few $100 billion, and we continue to be a deficit spender because of all the debt we have. So the macro view is everyone's focused on these little things going on, but they're missing the steamroller of debt and interest expense that's coming at you live and in color across all G10 countries. So I leave it to the audience before we go over to you. Keep watching gold. That is going to have a breakout, we think, beyond 3,000. And Bitcoin, we think, is digital gold. At least our research shows, and that for reasons we always discuss, we'll continue to follow. And now we drop it off to you, Connor, and have you and Bill, go after how your multi-asset portfolio is a great opportunity for folks as this mismatch of macro factors confuse the traditional audience.
Cool. Thanks, Mark. I think at some point we may need to do a little bit more of a deep dive on gold and making this comparison to digital gold and things like that, but certainly not for today. So as I mentioned, I've known Connor since he was in college. He was an extremely brilliant college student when he was at AQR, and he taught me a lot. Just kidding. I would like to think I explained a few things about quantitative investing to him over the years, but he certainly excelled at AQR. And then, thank you for joining us, Connor, again.
Yeah, Bill, no, I Mark, Chris, really so happy to be here. I don't know about all that, but I'll take it, Bill. Just very excited to be here.
Cool. So I guess, do you want to just tell us about how you started Truvius?
Yeah, sure. And maybe I'll dial it back even to, my time at AQR and how that sort of
I was going
led
to jump
to.
in here, Connor, and say, yeah, because you and Bill worked. He's saying intern, but I'm saying, was there some stuff that you and Bill have shared stories that's fun? But maybe should we hold that for the end, Bill? Because
Sure,
all right, you go ahead.
maybe. Bill, you can obviously jump in at any time, but it's true, Mark. AQR is the only place I'd ever worked before starting Trivius. I interned there, and I 2 weeks after graduating, I moved from Boston to New York City and worked there for about 6 years. I think if I'm thinking about that right, but first half of my time there, I was really focused on the macro side of things. So worked. The firm is, in terms of the investment strategies, is generally split between asset allocation, so global macro and risk parity and all these different things that don't focus on equities. And then there's a stock selection side of the business, pretty much an equities focused side of the business. So the first half of my time there, I was in the research group on the global asset allocation side, working on global macro relative value hedge fund strategies, for large institutional investors, pension funds, endowment funds, et cetera. And it was just a really, really cool 360-degree view of factor investing and what it means to invest systematically in these large liquid asset classes and how it all comes together, both from a theory point of view, starting with academia and financial theory, and then converting those theories into executable lines of code and spitting out trade orders. So really getting a full sense of the entire life cycle of quant investing. Second half of my time there, I moved over to that stock selection group. So kind of the same role, same seat, but just different asset class and some different strategies. But just a really cool training ground for kind of getting started in the investing world. And I'll just say about AQR, such an amazing place and excellent people, and really just a fantastic opportunity in my career. And it forms the basis of what we're doing at Truvius. A lot of what we're trying to do is take that style of systematic investing and factor-based research and systematic portfolio construction and apply it to the digital asset class. And specifically, the distribution path we're taking right now is through long-only, actively managed SMA products for wealthy investors. So I can talk much more about Truvius, but that's sort of how, my time at AQR led to what has now become Truvius. Yeah.
That is actually very appropriate, I believe, Connor, because as you'll probably point out, some of what you're doing now is drawing on your experience at AQR. And I think, that there's probably some overlap with the type of investor who invests in, AQR products as well as Truvius products. So, maybe we can get into the typical type of investor and things like that later. But, and I had some actually, more quantitatively driven questions, but can you just give the audience an understanding of what this all means? I think you described a bit about AQR, and one thing they did is very transparently demonstrate what quantitative principles are and how they apply them in their products. So I believe that's more or less what you're striving to do with crypto. But can you, just for the audience's sake, describe what your products are?
Of course, yes, happy to. Before I jump into that, I think you're right that not only is it similar types of investors, that would find this type of product appealing for digital assets, but the same types of people that are now building and kind of moving into the crypto world are also the same type of people that I think worked at AQR, and that type of innovative finance that attracted a lot of people to quant investing in maybe the early 2000s or 90s, whatever it is. You're seeing a lot of that migrate into digital assets now too. Like Talos is started by Anton, who used to be at AQR, and One River Asset Management, acquired by Coinbase, is a lot of AQR folks. So it's pretty cool to see that footprint grow in the crypto world. But in terms of Truvius, the one-liner is we're a systematic asset manager for digital assets. We're a tech-driven asset manager for digital assets. What that means is we're a registered investment advisor with the SEC. And the problem that we solve is that blockchain technology is evolving so rapidly, but the investment experience and the strategies, we feel, are not evolving nearly as rapidly as the technology itself. And so we want to provide investors a quality investment experience and actively manage diversified strategies that are really easy to access for digital assets. So in effect, what we are is kind of both a tech company and an asset manager, but we offer our products actively managed, quantitatively driven, long-only SMAs, which stands for separately managed accounts, for high net worth individuals, family offices, and funds of funds. We don't custody assets ourselves. We're integrated with a custodian bank, Anchorage Digital, who's been an excellent partner to us. And we really welcome their institutional quality and execution services. And once investors come to our website, they can sign up directly. We make onboarding really easy. And then once they're inside of our app, they can choose from our marketplace of quant strategies, and they select what they want. They can allocate to multiple strategies in their portfolio, and Truvius handles the rest, from rebalancing to portfolio attribution. So what we're really trying to do is pattern match to the quality and sophistication that sophisticated investors expect from traditional asset classes and apply it to the crypto world.
Cool. Thank you. I guess I've developed a much better understanding of the whole space as well as your products since we first caught up. But I remember the first question I really had was, how do you compare a fundamental quantitative equity strategy to what you're doing? And I'll just give one example. So value stocks. One thing quants do is try and buy good value stocks and sell bad value stocks. And the way you do that is you look at their SEC filings, you find out, how much their equity is worth versus how much the market cap is on the stock exchange. It's a very, very basic thing. If their accounting statements are accurate, then if there's a premium in the market, investors think that it's worth more than their balance sheet says, and vice versa. But I just kind of struggled. Like, what's the comparative factor for value growth, et cetera, in the crypto space?
Yeah, it's a really fun and exciting question too, because it evolves every day. But we do see comparable signals, or what you might call factors, within the digital asset class. And those exist both within a given sector. So I guess I'll take a big step back and I'll get to your question. There's now tons of crypto assets out there. I think there were like almost 2 million launched on Solana in the last 30 days. Um, a fundamental question
Say
is,
that again.
I think there were almost, fact check me on this, but I want to say there was about 1.8 million new tokens created on Solana in the last 30 days. I think the vast bulk of that came from Pump.Fund, but again, fact check me on that, please.
Who's being investigated, right? I think Pump.Fund got a.
Yes, exactly. I'm actually not super familiar, but I just saw that stat come across my screen recently, and I was kind of mind blown by it.
And yeah, I think we could even talk about this one thing you said for a long time, but I think high level, that means that a lot of people are creating meme coins and other digital assets. But perhaps for ourselves and our listeners, those aren't the same sort of assets we're interested in. And, correct me if I'm wrong, but, the Solana, I don't know, thousands and millions of new assets are maybe not our bread and butter.
No, and I didn't mean to derail us there, but really it's sort of, I was taking a step back to ultimately address your question of what are crypto factors? Are there comparables to value in the digital asset world? And a fundamental question before we even get there is, how do you determine which assets to invest in within the crypto world? And we apply a reasonably conservative approach towards that. They have to meet a certain level of price history. They've had to have been around for a while. They have to exist within a defined sector and have a defined business model. And when we apply all of that criteria, we're ultimately investing in about 30 to 40 what we consider to be investable crypto assets.
From Connor, there, I don't think your departure into the millions on Solana was, I'm going to go back and address or highlight what Bill talked about. It's important to make that distinction. And, part of the reason why we have this call is that, there are some, fakers, fraudsters out there and some people doing things on Solana that's great on a layer two, and some that is, YOLOing with a new meme coin of du jour. And as Bill said, and you said, you're taking disciplines you've used under previous SEC registered organizations like AQR, where you were, and you're applying them in this new realm to get not millions, but how many tokens meet your criteria as you look at everything?
Yeah, exactly. It's in the order of a small dozens right now. That's a really good point, Mark. And it's kind of what we were talking about, a little bit before, which is there is a lot of this early adopter risk premium associated with crypto. And it's the market is separating wheat from chaff every day. The way we think about investing is we want to provide investment strategies that gain exposure to what we believe to be quality assets with legitimate value over a long-term period. So, we will think about things on a very long-term investment horizon as opposed to very short-term, meme coin trading. We actually don't even offer any meme coins within our portfolios. I'll try to jump back in, Bill, to your question of, what are crypto factors? What do we look for? We actually started first by doing momentum research, price momentum research, and both directional and relative value research. And we saw that not only does it work, but it tends to work quite well. The momentum factor is quite pronounced when you apply it in certain ways for crypto, especially when you look across different sectors and apply momentum across different parts of the crypto economy. Can be really noisy and less effective within a single sector, like applying price momentum to just DeFi assets, for example. And this got us curious. We thought, okay, if momentum has some interesting effects, like are there different concepts of measuring value? Because you first have to start from a place of believing that digital assets or being able to identify that digital assets possess fundamental business value. They're not just valueless tokens trading from one hand to another for no reason. And I can get more into tokenomics if we'd like, but a good example that I think helps people start thinking about value is looking at fees that are transacted across protocols and networks. And we look at, concepts of value might be called more something like adoption or usage of a protocol. So if you look at DeFi assets, for example, how much in fees are these protocols generating? How much are users paying to actually transact on these protocols? And we're seeing, billions in dollars of fees being transacted over time. And something you want to look at is, okay, if a protocol is generating fees, like what's its market cap? What's its TVL? How much is, a protocol generating in fees relative to its size? If it's a really bloated market cap and not, generating a lot of fees, you might consider that overvalued. If it's a small market cap asset that's generating a ton in fees, doing a lot in transactions, has a lot of assets staked on the protocol, that would be something we might be considered cheap or undervalued. And when you back test these things, and after you've started from this place of developing like an economic hypothesis of what should be cheap and what should be expensive, we see that these things are these signals perform well, and that they're actually lowly or negatively correlated to price momentum factors, which is kind of interesting because that's exactly what you would expect for price and value for equities or any other asset class. So I don't know if that addresses your question squarely, but we use a combination of off-chain data like price momentum and on-chain data like fees and TVL and fees per user and that sort of thing. And we use that to tilt our portfolios towards assets we like and tilt away from assets we dislike. And with Truvius, long only and active strategies, you're still getting mostly beta to the market, the way you would with a long only active anything kind of.
Yeah.
But our objective is to beat a benchmark by a certain amount of annualized tracking error, and that's the approach we take.
Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe, as it really helps us grow the podcast and bring you great content. Thanks for the support.
Okay. Thank you for that detailed and well thought out answer. I believe it does address my question. And, interestingly, I guess anecdotally, one of the first things Cliff did coming out of University of Chicago was,
hold on. Let's. I know Cliff. Not everyone does. Let's roll it back a sec here. Who is your friend Cliff?
My friend Cliff Asness, who every once in a while you can see him at a Yankee game sitting behind home plate. So they'll actually the camera shows you on TV. Anyway, Cliff Asness is the founder of AQR, where both of us worked. And I would like to say he was my friend. I used to answer a lot of his questions, in the middle of the day about what was happening in portfolios. And sometimes there would be like a bad data feed or something that I was kind of responsible for fixing. And he was always very thoughtful and helpful with his questions, and I was sort of required to answer in a timely manner for everyone at the firm to observe, and that was a lot of fun. So yeah, I think Cliff is like I just mentioned him like first name. He is a legend in the quant industry, and what I was going to say is that he left the University of Chicago PhD program to go work at Goldman Sachs and then eventually started AQR. And, one of his big contributions to quantitative finance was actually putting the momentum factor into a portfolio and actually trading it. So, to back up a little bit, econometricians don't typically believe that there's a good hypothesis-driven reason to bet on, momentum or sentiment. Typically you have to have like value. We actually think we're going to buy stocks that are undervalued. We want to buy stocks that have growth and revenue. And, sort of getting back to, Graham and Dodd, which, again, you're going to probably interrupt me and ask me to explain who they are, but, classic stock value analysts, require you to think about the intrinsic value of a stock. And if you think that the intrinsic value of the stock is out of whack with what the market thinks, it's either a buy or a sell. But momentum, which is really just price action, doesn't really meet that criteria, right? You're basically just betting on sentiment. Like, people really like this stock over the last few months, and that means it's going to continue going up. There isn't a good sound econometric hypothesis around there, but Cliff, proved statistically that it's a real thing. And I guess I'm giving a bit of a shout out to him. And I understand that, he even may have had arguments with, Eugene Fama about this exact concept. And, I understood that. And if Connor, if all he said is, oh yeah, we're doing momentum factor, I'd say, oh, okay. Yeah. It seems like, I can tell when things are going up, and, that's kind of scary because, these are very volatile assets as we've noticed. And, momentum is just the most obvious thing that would drive value in crypto to me. And I should probably stop talking now because I'm sort of going off on a bit of a tangent. But one thing that confused me very early on was people would talk about market caps for these different crypto coins, and I was like, what's market cap with a currency? That doesn't make sense to me. You can think about economies and things like that, but part of what Connor was explaining when, answering my value question is these protocols and blockchains and tech, really they're just technologies that are, similar to technology companies, are enabling transactions, or they're providing a service. And the coins that are traded in the market, in the crypto market, are not, currencies to just transact, across borders and things like that, the TradFi experienced people like us, Mark, like that's what we know. We know about, cross-border transactions and how currencies play into that. But these are actually reflections of the value so that's the market cap analogy. Rather than investing in the equity of XYZ tech company, you invest in the coin. And therefore, when you're creating value drivers for the coin, you want to come up with something that's similar to like accounting information, or, what I think we can also describe them as our KPIs. So same store sales would drive the valuation for a retail company. And Connor's saying that they're looking at fees and other things that are generated from these, protocols and blockchains of transactions as really the drivers of value. So yes, Connor, my long-winded way of saying thank you for addressing the question.
So Cliff, it was okay talking about Cliff now, or Mr. Aspen, because I didn't help him out as Bill did with the reams of data that use AQR. So Cliff Asness is important because he made the jump, from PhD to a bank, and then created a new investment approach or accelerated one that was in the works. Dovetailing off of your question, Bill, and maybe narrowing it down a bit, for me and our audience, Connor, could you do a side-by-side of the KPIs that Bill mentioned about, like, well, in traditional work, people look at financial statements. They come out quarterly. That's the frequency. Then they'll try to get a little cuter and use these KPIs, like Bill said, and say, well, if it's a retailer, maybe there's published same-store sales that come out monthly maybe or weekly. And then maybe there's something else where we can hire people to go to stores and monitor traffic data or cars in a parking lot and those types of KPIs, which
Yep.
take time and money. Can you kind of iterate maybe what you looked at AQR and then maybe what you do now at Truvius on a data
Yes,
input?
absolutely. First of all, I'll just say on the Cliff Asness topic, I completely revere him as an investor and just thought leader. It's important to know he also hates crypto, and I think this entire conversation would probably nauseate him if it ever found its way to him. So, which I find really interesting, and we can talk more about that. But yeah,
sorry to interrupt that.
yeah.
Felt the same way. I remember I learned about crypto sitting in the snack, what do they call it? Cafeteria. It wasn't really a cafeteria, but in the lunchroom at AQR, I remember some of my friends told me about this thing called Bitcoin, and I was like, what the hell is that? And then, 12 years later, I finally decided to put some investment into it. But I think there are a lot of people who share Cliff's beliefs, so it's good that you just
Oh
acknowledge.
yeah. Oh, and it's important to start off as a skeptic. I did too. When I first started looking at crypto, I thought it was, everything you first think of when you hear that word. You think scam, fraud, bad things. Um, and then you kind of get pulled into the rabbit hole of blockchain data and what are these technologies doing? And my view completely shifted. All of this ties together. So to answer your question, Mark, at AQR and really any quantitative investor, they're taking relatively simple data points. For as Bill mentioned, you look at a lot of accounting related data, and you build then really complex kind of machinery around it, which is where a lot of the technological hurdle that a quant shop brings really comes into play. So for stocks and equities, you're looking at things you want to go long things that have a low PE and short things that have a high PE. I think I said that right. But go long, cheap, go short, expensive. Do that across thousands of stocks. And over time, the idea is you deliver attractive risk adjusted returns. Extend that to a number of different factors for a number of different asset classes. For currencies, you could be looking at purchasing power parity. For commodities, you could be looking at more technical factors like how it rolls down the curve or something like that. But the idea is you look at what makes sense intuitively, starting from an economic hypothesis, and you build rules around it that a computer follows systematically. For crypto, we take that exact same approach. We're just trying to figure out what are those factors, what are those KPIs, and then once you even identify those, how do you give weight to those factors? Which ones are more important than others? And that's also kind of a heady exercise too. But to go back and say, what are these factors and what are the comparables in the crypto world? It's not exactly a one-for-one match. And it gets even headier than that because these different protocols have different mechanisms, and the way they transact is different. You can't necessarily look at the number of transactions on Solana and compare that to the number of transactions to Ethereum and say,
Well, that's
which one's,
similar to
yeah,
equities where EBITDA is necessary for maybe United Rentals, but not for Amazon. So I
totally.
mean, that seems like it's analogous where you got to use your
That's a good point.
expertise,
That's a really good point, and that's true. And it's on the part of the investment manager to figure out how to normalize these things or standardize them across different assets. And so we look at both levels of these metrics and we look at changes of these metrics. What is the 30-day, 60-day, 90-day, change in these sorts of KPIs, as you mentioned. So there are these sort of tokenomics level KPIs, things around like how much value is locked on a protocol. How do these things relate to each other? Like, what is the ratio of fees to the total value locked? How has this changed over that X amount of days? So we look at all of that, and we look at that. What's the ratio of those things to the number of active users? And then someone might say, okay, you're measuring all of this activity, but what is the activity for? Like, is there any reason these people are, users are transacting things on these protocols? Like, if I'm just swapping Uniswap to, between each other on Uniswap and, that's the end of the story. you might say, well, that's still not value. It's just a measure of kind of like usage, which is partially true. Um, but the value is still something we actively research and try to figure out how to measure. But there's so much that crypto is reinventing in a positive way that's solving problems that traditional finance or really a lot of sectors have. Things like automated market makers and the decentralization of exchanging goods and services. That technology is we believe is valuable. And to be creating these decentralized, permissionless systems that are, peer-to-peer exchange mechanisms, we believe is valuable. I'm kind of harping on the DeFi sector, but there are other business sectors within the crypto economy we view as valuable too, like Oracle's Chainlink as an asset, for example. How do you take data that lives off chain and put it on chain? And why would you even do that? I know you guys talk a lot about AI on this podcast. There's an argument that AI and crypto might start talking a lot more to each other, because if you can take data that exists off chain and put it onto this network that's decentralized, private in some ways, and secure, AI can ingest this data and know that it's true and verify it in a way that you might not be able to do off chain. So there's that sector. There's gaming and Web3 and metaverse. So I'm kind of going all over the place, but I also want to just establish that we do view the crypto economy as having differentiated business sectors. And it's important to kind of decompose to us the market between those, to cluster assets, in a different way across sectors. It makes it a little bit easier to digest and identify where the value specific to a given business sector is. So for Web3 and gaming, you're going to be looking at users, in-game play, in-game rewards, NFT sales, things that are related to that specific sector. For smart contract platforms, you're going to be looking at gas fees and number of contracts deployed and things like that.
So I think this is a good opportunity for me to plug a recent paper I published on SSRN. What you're describing right there is, I think, model-based quantitative investing. So when you discuss sectors, that's just one way to group similar companies. And,
Yep.
A lot of times what you're doing is you're playing a good company in a sector off of a bad company in a sector. That's like the long, short nature. And I think in a long only portfolio, are you just increasing the weights on, good companies in, gaming versus bad companies in gaming? And even talking about investing in online gaming or whatever that means is probably a discussion for another day. And old timers like Mark and I need to understand what all that means. But is that really what you're saying? Like, you construct groupings of signals, or I'm trying to use the most plain English language as possible, but when you have these drivers of value, which we a lot of times talk about as factors, within segments, you can think about ones that are have a better outlook versus ones that have a worse outlook. Maybe that's the easiest way to think about it.
Yeah, I think that's true. That's true, Bill. I think you and I have a problem using the word factor, or at least I do sometimes, because as quants, you would expect a factor to be something that's existed for 100 years or 50 years. And so blockchain hasn't been around that, or at least crypto as we invest in it hasn't been around that long. So we'll say something like signals or metrics. We internally say factors too. We look at both signals within a given sector, and we look at signals that work across sectors. Price momentum is a good illustrative example of something that works across sectors well. But at Truvius, we build our own custom indices that are themselves investable, so investors can pick from a DeFi index or a value transfer index or a smart contract index, et cetera. We also offer size-based indices like mid-cap, large-cap, mega-cap. And then we offer what are called models, and those are investable portfolios that have a strategic allocation to numerous underlying indices. So I think it's helpful to provide that depiction just because the way we think about investing is we create portfolios that will invest in 5 different sector indices, for example. And we give weight to those indices that are roughly in line with market cap. So when we talk about Web3 and gaming and these more, smaller cap sectors, we weight them kind of in line with the market. They get a smaller allocation. Things like value transfer and smart contracts get a bigger allocation. And when we're managing these portfolios, we manage it in the sense that we're going overweight or long the assets according to both the signals that are within a sector and across the overall portfolio. So we kind of have 2 levels of conviction or not conviction. We say, does this asset look good relative to the assets in its sector? And does it look good relative to the assets across the entire crypto economy? And we like comparing things on that kind of dual level because it gives us a better sense of how we should overweight and underweight assets. I'll also just mention, you didn't ask this, but now that I'm on this train of thought, the idea too is that we want our active returns to be uncorrelated to the market. So the excess return you experience is over the long term expected to be about 0 correlated to the market overall.
The crypto market.
The crypto market. And it's without plugging Truvius too much. Sorry if I am, but we offer passive portfolios, and the benchmark for our active portfolios is the passive version. So that when we say the market, in Truvius terms, we mean the passive version of the 40 assets we invest in.
And I make that distinction for the market portfolio is this conceptual thing where you invest in everything, and
right.
So it's presumably uncorrelated with the 60-40 portfolio, which is another proxy for the market. And then don't others already do this? They, invest in the top 10. If you just invest in the top 10 coins, it seems like you would get the exact same thing. And, I think people would be willing to pay a lot for that, right?
Yeah. So you're teeing me up to get all hot and bothered with, these top 10 products that we see out there. It's a really good question. These top 10, even top 20, whatever product you might see out there, it's still primarily going to be about 85 to 90% Bitcoin and ETH. So investors should ask themselves, what is the purpose of a product like this? And am I paying a reasonable amount for it? I don't know if that was exactly your question, Bill, but the way we think about it is...
Oh, I think it was.
Yeah. Yeah. And Bill, I might have lost sight of your original question, but the idea is we want to provide people a little bit more exposure to what are traditionally referred to as like the alternative crypto assets or the alt tokens than you might see out there. But it also kind of gets into, you're not really asking this either, but holding spot assets versus holding ETF assets, and that's another topic. But it's a good question.
Yeah, I think, the market cap weighted index might be an analogy for that top 10 thing. But yeah, yours is more risk balanced than simply just investing, 70% in Bitcoin, or sorry, 80% Bitcoin, 10% in Ethereum, and then 10% in everything else, and not really balancing it or rebalancing it in the future. Chris, sorry I interrupted you. Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe. It really helps us grow the podcast and bring you great content. Thanks for the support.
No worries. I was going to ask, how are you determining weights of, say, fees and revenue versus monthly active users, of the KPIs? How are you determining those weights? I'm curious.
Man, that's a really good question. It's also, it's part art, part science. It's a subjective decision ultimately. It's, you try to backtest and come up with economic theories about why certain factors should have more weight than others. It's something that also changes over time, but really it's the discretion of myself and Max and, the Truvius team where we think these factors, they're a little bit more predictive or have more explanatory power than others. And so you look at things on a statistical level, and you kind of just evaluate it over time. But we try to give more weight to the things that are intuitive, make sense, and perform well. And you also look at how diversifying factors are to each other. So you want to, when you include factors in a portfolio, you want to make sure that they're lowly correlated or communicating different things, as opposed to having a bunch of correlated signals. So it's a bit of an unsexy answer, Chris, but it's it's kind of where some of our expertise comes into play, and we try to make decisions in an informed but subjective way.
Yeah, I just finished writing a paper this morning on Ethereum and its competitive L1s and supplemental L2s, and you look at revenue and fees on Solana versus Ethereum over the last 6 months, and Ethereum has fallen off a cliff because of the Duncan
Totally.
update, and Solana has risen significantly. And I would argue, it's pretty obvious, and we were talking about this earlier, because of the meme coins, right? So I'm curious, do you discount the fees and revenue of Solana because of all of the meme coin hype that's around it? You can look back to the NFT craze of Ethereum, and 99% of those have lost value, So I'm curious, like, how you think about that with Solana currently, with the meme coin craze.
Yeah. So, Chris, I think your question was, do you discount the meme craze on Solana
Yep.
versus, I mean, an inverse of that question too is, should you not overlook the substantial economic change to Ethereum? Is Ethereum undervalued right now and really cheap because of the change that took place? I forget exactly when it was, maybe this
Last
summer,
March.
last March. And so I guess those are two sides of the same
Sure.
coin. That's a bad pun, but part of it, I guess, depends maybe on your time horizon too. If you're ingesting a bunch of data from and just pulling it off the chain, and all of a sudden you see all these fees and activity occurring on Solana, that it might be a legitimate reason to buy that asset. It's kind of almost like a momentum style, like momentum value combination. So if you're looking at these things on a very short time horizon, then you would buy maybe. I don't know if it's exactly addressing the question of whether that activity represents true value.
Sure.
Ultimately, the answer is I don't know. We haven't made any structural discounts or changes to the factors based on that, but it's a great illustration of the need to constantly tweak and maybe normalize your factors, or look at your signals and say, are these signals like actually measuring things apples to apples? It's a really good question, and it's changing all the time. So a really long-winded way of saying I don't know.
So, Connor, I'm going to go back to what Chris just mentioned on his Ethereum report. Were there any persistent metrics that you found, Chris, in your report that persevered and had dispositive power? They basically signal versus noise in the Ethereum ecosystem.
What are you asking, Mark?
Like TVL versus gas fees. Was there any KPI that you found that had persistence? Because what Connor's talking about, which and Bill were saying, hey, market cap's okay, but market cap doesn't persist. Just look at FTX in a very rapidly evolving ecosystem. So we need to look below the layer at these inputs, on-chain data, and give our own art and science impact, because it's a more dynamic environment. That's what I think I heard you say, Connor. That's why an active portfolio makes sense in crypto versus equities, where things persist. You can be, lugging along in a top 10 name for a while. So I guess, Chris, what I'm asking you, to help evolve Connor's process, not that he needs it, is there anything in your report that you found that was persistent, that was like, hey, TVL used to matter, but it doesn't. Now it's more about layer 2 gas fees that will eventually give value to Ethereum. So I'm just saying, was there anything that you found?
Yeah, the outcome of my paper really kind of looked at Ethereum's decision to scale for the future. and that's where I see Ethereum's value. And I see it in two different places. I see it in tokenization of real world assets and stable coins. Those are the two metrics that stood out to me pretty starkly. Most of the tokenization, or almost all of it, has happened on Ethereum up until this point. And stablecoin store of value has been on Ethereum, I think 70 or 80% there. So if I look at those two metrics and then look at the decision Ethereum has made to scale for the future with L2s, and I think Base is a great example. Coinbase created an ecosystem on L2 to build on top of Ethereum, and they've brought a massive amount of stablecoin and activity through their chain. So I think looking at its decision to scale to the future, and then looking at the potential of value that can come from traditional finance through stablecoins and tokenization of real world assets, that's where I see a lot of value, future value for Ethereum. We're kind of getting to the point that I was asking you about, Connor. Solana to me seems its current value is inflated because of the meme coin craze. And to your point, you're not really sure where it's going to be in the future. Are they going to continue to have that value going forward? Is all that going to disappear when meme coins fall off the cycle at the end of this 4-year cycle? I don't know either, but I'm betting on Ethereum long term because of tokenization and stablecoins.
Yeah, it's a great question, Chris. And from my perspective, a lot of times I get asked like, "What's your position or view on this asset?" And the answer is, I don't know. I don't know for long or short, but our model has some view on that. And the nice aspect of a systematic process is that when that sell off or deleveraging off of all of this fees occurs, the systematic process should just ingest that and adjust accordingly. So a lot of times my answer to things like these questions is I don't know, but our rules are codified into our system that should systematically just know okay, it's time to go underweight Solana and overweight Ethereum, just from a process point of view.
Great. We are getting pretty deep into the weeds, and I was trying to find a better analogy for the layer 1, layer 2 thing, and I think like one way to think about it is layer 1 could be like the database that stores the transactions, and layer 2 could be like a web page that allows you to view them and sort of maybe there's another app that collects data that then puts it on the database, and we'll assume that our audience are pretty conversant in crypto, so I'll just leave it at that. But
yeah, I wrote an article on this, Bill. The way I explained it was, if you think about L1s, it's a Google Sheet, right? It's a decentralized database that anyone has access to, and layer 2s are essentially just separate Google Sheets that roll up to that top layer Google Sheet, right? It's like a separate database that rolls up into that main database. Is the easiest way I can explain it.
I like the Google Sheet analogy, and I was also going to say we're starting to run into our time limits if we're trying to keep this under an hour. Connor, is there any place where people can find out more about Truvius?
Yeah, of course. Thanks for asking. You could just go to truvius.io and get all the information you'd like there. You can sign up and invest with us too. We, of course, love that. We have a YouTube channel where we put out a lot of educational content, but the easiest place to go is just truvius.io.
Is that the only place where people can find you?
Probably the best place. Is this a trick question?
No, I thought that you may have like a LinkedIn account or...
Oh, we have all that. Yeah. Twitter, LinkedIn, anyone who wants to find us will find us on those things. But
they just search for Connor Farley or Truvius or both?
Both. Yeah, do that. Google Truvius. We have pretty good SEO. Go to the website. Follow us on the socials if you'd like. But we're constantly pushing out educational content, and then creating an account is really a good way too to just learn about our strategies. Even if you just sign up and look at our models, you'll get a really cool firsthand experience and exposure to like what are these sectors for crypto and how does a model work and what is an index, and we push a lot of cool educational content to our current customers, and yeah, that's what I would recommend.
Cool.
Nice.
And I believe we'll also try and put some of this information in the show notes as well.
Excellent. Great.
All right. Well, Connor, thanks for coming. I don't think I have any other questions, but if I were to try to sum it up, you're steeped in traditional investment management skills, took it to a new playpen that requires them because it's very dynamic and you can't marry these positions. You got to rent them. And you're registered and you're in places other than your website. We got LinkedIn and places that traditional folks my age can find you because they may not be on Twitter.
That's totally true. Our marketing people would be very unhappy if with my pitch here, but that's all correct. We're all over the place.
Okay, good.
Yeah. Anything
else, gents?
Mark, I had a question for you. If I don't know how much time we have. I know you're self-described, maybe would you call yourself a Bitcoin bull or Bitcoin maximalist? Is that a fair classification or no?
I would say that I am a Bitcoin first because I see the biggest opportunity in TradFi to get people on the most persistent, longest price history, monolithic chain with little risk and I think more upside. So I look at it as people can rent Bitcoin through certain rebalancing strategies. It's easier to explain than trying to go into other assets. Your purpose is different and unique and distinct. Mine is for a regular 60-40 portfolio or an RIA saying, where can I start?
Sure.
So that's why I went into it, because I'm lazy and I think it's the simplest, easiest, the alphas and the beta. Just understand this thing a little bit, people, please. So that's more it. It's almost a marketing play where it's just easier, I believe.
Sure. No, I totally get that. And the reason for introducing Bitcoin into a 60-40 portfolio and that makes a ton of sense. I was really just going to ask your thoughts potentially on the Bitcoin layer too, and whether you see that long term being competitive with some of these proof of stake protocols. And we may not have time for that, but
we're going to put a pin on that. We're going to pick it up in round 2 and say yes, I do.
Okay,
and it'll take longer.
All right, good. That's cool.
And I got to say, put a pin in it, which I know I'm supposed to get a buzzer for those type of terms, but I did.
Well, I'm happy that you brought that on our radar screen as well. Thank you. The only thing I was going to do is make fun of Mark. He brought up his age, and I was going to make fun of Connor for his age, and rather than say anything inappropriate, I think we can just wrap it up.
That sounds like a good idea.
All right, folks, we'll come back to it. Remember, grass doesn't grow in a busy street, so not everyone needs hair in their head. That's what I say.
Thanks, everyone.
Take care, guys.
Thank you. Bye-bye.